Today's conversation is with Joel Lin. Joel is the lead project manager, effectively the founder of CitaDAO. And CitaDAO is creating the tokenization of real estate properties starting in Singapore, but their vision is to move all over the world. Joel has a background in commercial real estate. He understands the market, and we talked about what exactly the mechanics are that allow for the communication and the authentication of the property rights as recognized by the government and then on chain. We discussed really exactly how that works. So the certificate of the property, how that's connected to the DAO. We talked about what the future might look like for investing in real estate. These guys are live. They have offers up now. You could check it out on their website. CitaDAO, they have a $40 million market cap on CoinMarketCap. They've raised millions for this project, and they're one of the leading platforms out there allowing people to invest on Web3 into real estate. So I hope you enjoy this conversation. If you do, please share it and give us a thumbs up wherever you're watching. Really appreciate your support. Here is Joel Lin. All right, Joel, we're live. Thanks for hopping on today. I'm excited to chat with you. I love what you're working on at CitaDAO. You took a ambitious direction to move in the direction of DAOs for real estate, having had a background extensively in real estate. Tell me more about this. Tell me more specifically about what you learned in real estate prior to CitaDAO, maybe your time in Singapore or something about the unique way that real estate works that motivated you to create something different.
Hey, Mike. Thanks for bringing me on this this session to introduce CitaDAO to the around the coin community. So maybe before we begin, a short introduction of my background. So my background is really in the institutional real estate space, and over the past decade or so, have been working on commercial real estate globally, structuring deals and so on and so forth. And that journey over the past decade or so has shown me the enormous potential of real estate on chain. The way we see it today, real estate in the real world, traditional real estate, is a very capital inefficient form of asset class. It takes a whole bunch of capital. It locks it up, and liquidity is so thin. Typically, if you're going to put anything into the property sector, you need to build at least a liquidity runway of between 6 to 12 months, depending on the size of the property, whereby you don't expect to see your money again. And this has kind of, in a way, in my personal opinion, depressed the price of property globally. I know that given inflation today, the price of properties globally have been going up. But the way I see it, in future, when blockchain start becoming the norm in the real estate space, there's going to be two sets of prices for every single property. And that's going to be the price of the property in the real world and the price of the property on chain. And my personal belief, as well as our team, is that the value on chain, the price of property on chain, will always be superior, higher in value than the one in the real world, simply because there's so much more exciting opportunity, use cases that can be generated on chain that we will never find in the real world today.
Gotcha. Well, I want to ask you a question about that. Why is you said the capital's locked up for 6 months in real estate? Are you specifically referring to the way that commercial real estate contracts are handled, or is this, elaborate a little bit more?
So let's say you put your money into the property, right? And let's say you have a $1 million property you put 1 million into the property, you bought it all in cash, okay, and for some reason or another, tomorrow you wake up and you find you're in need urgently of liquidity of cash to probably attend to your margin call on some of the crypto positions so that you don't get liquidated, and you go to your property and you attempt to unlock that value in the property. Now, there's two ways to unlocking liquidity in the property market today. The first way, obviously, is to sell it. And if you want to sell it, you have to go through the sales process. You have to look for agents, you look for buyers, and then even after you look for agents and buyers, you got offer price, you accepted the offer price. It takes a minimum of 3 months to 6 months to complete the legal process to transfer the title deed, and ultimately only when the title deed is transferred will you get the cash for the sale, right? So that's one. The other way, which is obviously faster, is to go and get a bank loan. But then bank loans, they don't take place instantly. You typically you have to go through a process of securing a banker. They will do credit checks, and then after you submit the bank loan application, okay, so maybe for the bank loan it might be faster. You might be looking at somewhere between 3 months to 6 months, but even then you're not going to get your liquidity instantly. Now,
is that for like a house, or is that for like a commercial, large scale commercial building?
Commercial building.
Got it.
Yeah, but for a house, right? Even if it's for residential house, you are not going to get your money instantly. Mm-hmm. You're not going to get liquidity instantly. You have to at least wait 30 days. For houses, it's depending on the type of house. The process for the bank loan can be faster. But even then, you're not going to get it instantly. Now, as compared to the blockchain universe, imagine being able to collateralize a real estate token, let's say Aave protocol, and within 5 minutes, get your cash out instantly to go and meet your margin call and prevent your portfolio from getting liquidated. That's the kind of efficiency we will be unlocking on chain that you cannot find today in the real world.
Got it. Okay, let's rewind a second before we go deeper into this. You've been in real estate for a long time. What's it like in maybe Singapore specifically, or are you doing deals in other countries? Like frame out a little bit what real estate, commercial real estate looks like. Does it vary country by country, or the same general structural framing happens in every different country? What are like the high level things you've learned from your time in traditional commercial real estate? So the first thing I learned is that commercial real estate is really the safe haven within the real estate universe, and that's also precisely why the CitaDAO project only deals with non-residential real estate. Typically, regardless of jurisdiction where we have gone to, we realize that when we operate within the commercial real estate space, the governments tend to give us a lot more free hand in terms of the pricing, in terms of buying, selling, in terms of trading, in terms of ownership, than if, let's say, a residential project. Simply because a residential project, they touch very close to the heart of everyone. Most people want a home to live in and stuff. So when residential real estate prices goes up, it's more closely felt than, let's say, a commercial real estate price goes up and down. So commercial real estate prices typically can be more volatile without the same implication than residential. So that's one. Now, secondly, commercial real estate globally tend to be a more illiquid asset class than residential, simply because you don't trade commercial as frequently as residential.
So because of that, as I mentioned earlier, the value that we can unlock from the commercial real estate space is going to be definitely much higher than how you would be able to the amount of value you can unlock in the residential real estate space. Uh, and thirdly, commercial real estate typically involve securing leases with businesses rather than an individual. So when you secure leases with businesses, chances are the business are going to put a bit of capital towards renovating the space. They're going to spend a bit more money to make it look good and stuff. And because of that, the leases tend to be a lot more stickier than residential, whereby you could have people coming in one day and deciding that, look, I'm just going to move out the next day. Whereas for commercial real estate, the leases tend to be a lot stickier because simply because there's upfront capital expenses poured into the space. Yeah.
Interesting. And what were you doing previously exactly? Like, let me ask you. Let me ask you the question in this sense: when you were working in traditional real estate, the concept of starting something in crypto must have been pretty distant. Was there a person you met or a conference you went to that sort of sparked your imagination to see how you can link these two worlds together?
No, that's a very good question, actually. So my and actually my journey into crypto kind of started back in 2016. At a point in time, I was first introduced to Ethereum, and I think Ethereum was about ETH is about $10 then, and I was told to just buy it, right? And at the point in time, being the TradFi kind of guy, I was I couldn't value ETH because there's no cash flow statement, balance sheet, and income statement. Didn't enter into ETH space until it got into the next year, which kind of shot up to $200, and then I bought it with both eyes closed, right? And then never looked back ever since. But along the way, what happened when ETH started gaining mass adoption was how smart contract started gaining traction within the space. And with smart contract gaining traction, everybody had the idea of actually tokenizing property, tokenizing real estate. And being on the institutional side of the of the space means that I am in a very privileged position of kind of being entrusted to manage properties on behalf of funds and stuff. And many of these projects, in order to tokenize the property, they need property to begin with. So they kind of came and spoke with us. And on the project side of the business, my senior management started to get interested in it. They say, hey, you know what? Maybe there's something to look at over here. Let's start looking into this. And being one of those at that point in time who know anything about crypto, I was kind of tasked with that assignment to kind of justify supporting these tokenization projects. At the point in time, though, I will have to caveat that there were two stumbling questions that kind of prevented my management, or rather my bosses, from actually giving the green light to support the tokenization projects with our properties. And the first question really has always been, so Joel, you are a real estate investment professional. You know what a GPLP, which is General Partner Limited Partner structure, is in the private equity real estate space. Now tell me, how is real estate tokenization superior to a GPLP structure? You talk about accessibility. Now, GPLP structure give you the same amount of accessibility. A limited partner could always hold 0.00001% interest in the GPLP partnership. So what is so special about tokenization that is superior to a GPLP structure that we are using today to kind of enter the real estate space? So as you can imagine, at the point in time, everybody is talking about how fractional real estate could lower the minimum sum required to acquire a property. But for those in the know, for those of us who are in the space, we know that a GPLP structure achieves the same goal. And to be better, a GPLP structure is actually legally recognized in the jurisdiction it's operated in, whereas your tokens are completely not recognized, right? So that is one major issue we had. Obviously, some of the argument that were made was that real estate tokens potentially could be more liquid, better liquidity than a GPLP structure, because for one limited partner to sell out your stake, to sell out your interest, is a very tedious processing task where you have to go find another limited partner, get a bunch of lawyers involved to prepare the documents to transfer your limited partner interest to the other limited partner, right?
Yeah, just that alone feels like it's huge enough to completely, reshape the whole industry. Just the liquidity and the transparency.
Yes, but transparency is not so important in that sense, because you just need to be able to sell your stake urgently when you need to, right? On short notice. And at that point in time, whenever we ask the projects that approach us, look, if we tokenize our building, let's say we have a $50 million or $100 million building, and we're going to tokenize that, right? And let's say only out of the $100 million building, only 1% is tokenized. So we hold 99% of it, and somebody holds 1% of it, right? So how are we going to sell the remaining 99%? Who is going to buy the token from us? Where's the demand going to come from? How is it going to magically appear from thin air, right? And even though there were many answers to this, we could never get a very convincing answer as to, if I'm going to sell, let's say, 20 million worth of my real estate token, who's going to buy it for me at the current price? Yep. Couldn't get an answer.
Why wouldn't it be? I mean, to me, I would think it would be retail investors. As long as that's legal, I would imagine anyone who is on the open market would now have access to this deal where they wouldn't have access to it before.
Yeah. So the concept of a retail investor just magically appearing to soak up your token is really, really is very it's a dream. Mm-hmm. It is the dream, right? Everybody wants that to happen. But if you look at the single asset REITs that are currently listed on, let's say, NYSE and stuff, right? You realize that the liquidity is super thin. And these are legal structures that retail investors could easily access any point in time. That demand doesn't magically appear. There has to be a reason why somebody is going to spend whatever hard-earned cash you have to buy a real estate token. And it's definitely not just because I want to own a fraction of the property. It has to be that by owning this real estate token, I can generate better return than, let's say, buying the stock or buying a Bitcoin or buying Ethereum, something like that, right? So from a risk-adjusted reward perspective, it has to be superior. And typically real estate in the real world, if you can get high single-digit return, it's very exciting, right? It's so boring that the moment you start talking about double-digit return, people think that it's a scam. Right?
Yeah. But isn't that the whole appeal? Isn't that the reason? I mean, people don't put people have a diverse portfolio, so they look at real estate as the more conservative, low risk, which it doesn't mean in any way that it's less valuable. It can be just as valuable to have a low risk area that you're able to put capital into and have that be, slowly growing over decades. Like if you're retired and you want to know where to put money, I mean, that's my intuition. Is that not, do you think? My intuition would be when you created this, your thought would be, hey, this is going to open up new investment opportunities for retail that wasn't available previously because it was only available to large institutional investors. But yeah, keep going.
The question at the end of the day is knowing that amount of liquidity is always there for you. So in a traditional world, when back in 2017, when DeFi wasn't a thing yet, most liquidity were provided by order book exchanges. So you need to have exchanges that have that $20-30 million worth of retail investors at any point in time ready to buy concurrently at the same time as when you're selling at the price that you're willing to sell before a transaction can go through. And we have seen many early attempts at tokenizing projects. Those that many didn't get off the ground. For those that get off the ground, secondary trading, secondary liquidity is so thin that, let's say, if I'm going to try and sell, let's say, $100 worth of the property token, the price movement of the $100 could swing as wide as 30-40%. Now that's not going to make sense. Like, I'm not going to sell my real estate that is worth $1 million in the real world for anything less much than $1 million, and definitely selling it for $500,000 valuation doesn't make sense to me.
Can I ask you this? Who are the typical buyers of these transactions? Is it investment banks or private equity firms or individually wealthy people buying commercial real estate buildings?
In the traditional, in the TradFi world, it consists of mostly your insurance funds, because insurance funds, so it consists of like your insurance funds, it consists of your sovereign wealth funds, it consists of your endowment funds, pension funds, and so on and so forth, being a major long-term holder of these asset classes. Reason being, they have ongoing plans. They have received huge premiums upfront. They need to deploy somewhere to ensure that at bare minimum they overcome inflation, right? So and these are large patient capital. So as you can imagine, these kind of funds are huge. For them to deploy into real estate is something that makes sense for them, because if they were to deploy that amount of funds into any other capital market products, it's potentially going to shift the price of the underlying asset, not so much the real estate, which can absorb the amount of liquidity. So that is predominantly where the bulk of the funds come in. Now that's the what we call the core asset classes, and then in between we have and those are the prime buildings, and then in between we have this thing called the value add asset strategy or value add funds, whereby you start having your private equity real estate players coming in. You start having your developers coming. This kind of play involve taking a property that is undervalued, repositioning it physically by engaging what we call AEI, so an asset enhancement initiatives, to either change the use case, increase the efficiency of the property physically, or generally just repositioning the tenant profile, and then get a better rent of the property and flipping it for a better price, either to another value investor or into a core fund like the insurance funds. And then at the short end of the spectrum, you have your what we call your distressed debt plays, whereby there's a strategy where funds actually go on the prowl for real estate developers that didn't do their cash flow properly and ended up running out of short-term cash flow and being in danger of being liquidated of their property portfolio, right? In this space, you can see returns as high as double digit, maybe even 20% over. But and the gameplay here consists of either the landlord successfully repay the loan and you get a 20% return on your capital, or the default on the loan and you claim the underlying land for a 20% discount. So that's those are the typical strategies in play in the real estate space. Yeah.
Got it. And so you have, just to recap it briefly, you have the pension funds, the insurance funds that want long-term stability to beat the inflation. You have the institutional investors like private equity that are coming in to improve the efficiency of the property to make it worth more. So they're actively doing something. And then you have developers that might like tear it down, or refinancers who are trying to refinance distressed assets. So those kind of like paints the landscape for traditional commercial real estate movers.
Yeah, and you have your real estate investment trusts naturally. So the real estate investment trusts are usually exit liquidity for developers.
Got it. And how does crypto, where did you originally think crypto would fit into this?
So as I mentioned, originally we thought that maybe it could make the GPLP structure more efficient by having liquidity. So and it was actually back in summer, DeFi summer, 2021 that concept really materialized. Because then you got your liquidity pools, you got AMM concept, you got the concept of yield, well understood by the crypto community. And what happened is that we kind of, a light bulb kind of gone off, and then we say that, look, if we could apply this liquidity pools, we connect them to real estate token. Now we have a structure that is superior to GPLP structure, because now instantly you get access, 24/7 access to liquidity for single asset property via liquidity pools, right? So we think that is one key area that crypto could play a part in. The second one that we are very excited by is the concept of composability. So being able to increase the use case by leveraging the DeFi space for real estate as a whole. The idea of being able to get a generic ERC20 real estate token and getting that accepted in other DeFi projects, such that you can use the real estate token to either create your own real estate indices, or you can use your real estate token to mint stablecoins. You could use real estate token to mint futures and options contracts that you could generate higher yield on your real estate property itself. You could use the real estate token to collateralize it, get instant liquidity, and repay the liquidity anytime without having to give notice to the bank, and so on and so forth, right? The enormous use case for the real estate on chain versus what it can only be done in the real world, which is to either use it yourself or to rent it out. That will add a new dimension to the entire real estate universe as a whole, because now you have the real estate price in the real world that forms your fundamental reserve value of the real estate token. And on top of that, depending on the demand supply generated by the use case, you get a significant premium that is unlocked that could give you a material advantage in terms of return that you will never be able to unlock in the real world.
So would this be, so let me walk through an example and just frame it out a little bit. So you have a building that's inside of a city and it's owned by, say, one, maybe for simplicity, we'll say one developer owns it and they want to sell it, and they're debating whether they sell it into this crypto pathway or they take the traditional pathway. And if they take the crypto pathway, that would mean they're selling it into practically, what are like the steps that an owner of a commercial real estate building would go through? And maybe start there.
So the owner of a commercial real estate will will be able to decide to uh, sell it in the real world, or they will decide to sell it in the crypto space. Naturally, when you reach a decision to sell, you have a reserve price that you have to meet, and you will naturally always sell to the highest buyer, uh, with the understanding that you obviously you have to do your own due diligence to make sure that when the process complete, the buyer actually have the cash to pay you. Yeah. So to be honest, it's the way I see it, it will be a very simple process. It's just going to be something that sellers are used to. You engage your lawyers to undergo a transaction. You receive offer price, and the way we see in the future, when as the real estate on chain start gaining mass adoption, potentially we will see that if I were to sell this commercial property in the real world, I'm going to get $1. But if I will sell it in the on chain, I'm going to get $1.1, so 10% premium, for example. I'm naturally going to sell it on chain. I'm not going to sell it in the real world because I'm going to get more cash.
Can I maybe tell me how this is wrong? So somebody owns 100% of a building. They want to sell 50% of it on chain. So there's a company that comes in and they audit the validity of the building, make sure that it's structurally intact. There's no issues with it. And then there's a profile created online of this building, and it says this is the available percentage that's allocated for crypto investors. And there's a go live date, like January 4th, it's going to be live and you're going to be able to purchase. And maybe there's even like an incentive structure where the sooner you purchase, or you can pre-purchase to express your interest, you can like stake money into this profile prior to it going live. It's like a pre-launch. So you gauge, so the campaign is able to gauge interest based on staking. And then it goes live, and whoever was staked converts into tokens at a discount at the valuation of the token. So like say it's a CitaDAO DAO or CitaDAO token. So some like building token is converted from crypto staking into the actual token. At that point, there's a period of like a month where this is like a campaign, like a Kickstarter campaign or something. And then investors can come in, they can invest in this project, into this campaign, and there's up to 50% allocation of the building. So you're buying like 2%, 1%, 0.2% of this building for the price. And in the simplest way, once it hits 50%, then it's capped. Like then there's no more open shares or open tokens to be purchased. Now you have like kind of this market dynamic where you have the current price, and then there's like this is separately, you have like a dynamic where there's supply and demand, and there's a set price, and then you have a market maker that effectively connects buyers and sellers who want to get into this. So if I'm a insurance fund or real estate fund, yeah, I could go and buy one building, but maybe as a way to diversify my risk, I want to buy like 1,000. I want to buy 10% of 1,000 buildings, or 2% of 1,000 buildings. So now there's more risk mitigation. There's more intelligent portfolio building on chain, and as long as the on chain accurately represents the off chain asset, then I think there's if that integrity is maintained, because what you don't want to happen, obviously, and I'm sure you've thought of this, is like, what if the owner of the building sells 50% of the building on chain? People think they own it, and then he goes and sells 100% of the building and just takes the cash and disappears. Like, so maybe I'll throw all that at you and let you respond with what you think.
Precisely. The last part of it is the most important part, actually, and it's also one of the advantage of tokenizing real estate versus, let's say, tokenizing other asset class, movable asset classes. Like recently, I've seen someone say cruise ship, right? It's very different. Because real estate is always is an immovable asset, which means that whoever the owner of the property is determined by the government of the land, where the real estate is located on. Whereas, let's say a cruise ship, for example, you can go and you could go and register in multiple different jurisdictions, and then tokenize it in multiple different jurisdictions, and then subsequently get like 3 times, 4 times, and then run away with all the money and maybe even with the cruise ship, and leave all the jurisdiction to go figure out who has claim over the cruise ship, right? In the case of real estate, the owner, the owner is basically who the government say is the owner. There's no dispute about that, right? Now, in terms of being able to tokenize the building, okay, and then double dipping, basically after that, selling the building and taking both the token, the money raised from the token and the money from the sale proceed. That is actually one of the very material challenge we had to answer when we were building the project. And the solution to that is very simple. In order to prevent that from happening, there needs to be a very simple capital structure, a capital stack in the real world, whereby you can't have like multiple debt agreement and stuff. On the CitaDAO platform, whenever you tokenize a property, effectively you're taking all the debt in the real world out of the property. The property becomes 100% equity, and any debt for the property you take will have to be done on chain. Now, the way we have designed it, the legal structure is also such that the real estate token have the only right, or rather, the real estate token are the only ones with the right to actually redeem the title deed of the property. Which means that, let's say, if you take this property as the landlord and you want to sell it subsequently, and the person who bought the property subsequently tries to transfer the title deed into his name, he won't be able to do so. And if, let's say, he transfer money to you already in exchange for the title deed, the only claim he has is to go after the landlord who ran away the money, and have absolutely no claim over the title deed. And the way we do this, ensure this is to make sure that whenever a tokenization exercise is successful, the title deed of the property have to be transferred out into a brand new SPV. 100% held in equity. Yeah. So when that happens, effectively you get clean title. Nobody else can lay claim on that title deed. Because if there's any existing creditors who maybe have claims over the property, all their rights will be extinguished the moment there's a transfer title deed into the brand new SPV.
Can I ask a question? Does the government recognize, either in Singapore or other countries as well, will the government recognize multiple owners, just like a company? So an LLC or C Corp, you can have 30 different owners that each have different shares. Is that true in commercial real estate, or is it more like a car where I think the government only recognizes one owner of that car, like one owner of the title of the car?
The legitimate owner, the true owner of a property, is whoever appears on the title deed of the property.
And that can that be an LLC? Can that be a company that owns it, and therefore you can divide up ownership through the company?
Yes.
Got it.
You can do that. But that's not how we structure it. Because the moment you structure it this way, there are implications. The first implication is basically if you are a fractional owner of the LLC, depending on your jurisdiction and depending on where the property is located, it might actually be illegal to be owner of the LLC, because in some countries, some jurisdiction, if you're not a local, you're not a citizen of the nation, you're not allowed to own the landed property, for example. So those are complicated land laws, and it's fragmented. Even in some countries between states, the same law can apply very differently. right? So that's one of the complications. So the moment you start coming out with this legal structure, whereby you're offering fractional ownership of the LLC, maybe it might work in this state or this country, but if you go to elsewhere, it won't work. So that's going to be a scalability issue. The second problem with such a structure is in some jurisdiction, there's a minimum number, there's a maximum number of shareholder a company, for example, can own. So if let's say there's more than X amount of shareholder, let's say 50 shareholders, it might be under law that the company that has so many shareholders have to have to IPO. It will have to be a listed company. Yeah. So depending on jurisdiction, the laws vary. So to come up with such a structure is very painful. And the thing about it is that we realize that many tokenization projects actually don't realize that they came up with these structures, and then I'm like,
yeah,
come on, if you're going to go do it, that's the reason why private equity real estate funds don't use such structures, right?
Yeah.
And then so that's and then there's also the other part whereby I've seen some projects whereby they say that, okay, let's do as a LLP instead. So LLP, maybe you don't have to fulfill the company act, you don't have to go IPO, but so you can run as a partnership throughout. But a partnership is what a partnership is, which means that your liability as a co-partner in the partnership, you might have to take on the liability of other partners. So then you have cross liability between the partners. I mean, that's why you have a GPLP structure whereby if you set it up properly, not say a normal partnership, but set it up as a GPLP kind of partnership, whereby you got general partner, limited partner. Limited partner, the liabilities are limited only to the potential loss of the whatever money they put in. But the general partner potentially could have unlimited liability, right? However, I've seen some projects whereby they just put everybody as a general partner. So it means that, in the interest of a DAO, for example, you say that, okay, everybody needs to have the right to vote, the right to make decisions. Limited partner cannot make decisions in the GPLP. They just put the money there and they have to be sleeping partners, right? But in some cases, DAO say, everybody has the right to vote, so everybody is a general partner. In such cases, right, it means that if tomorrow you go down under, I might be liable for your debt.
If you go down under, wait, what did you say it again? So if
if let's say the partnership go down under because of so let's say one of the partner, right, goes out, represent the GPLP, takes on a huge amount of debt. I mean, think of 3AC, for example, right? Mm-hmm. And then subsequently run away with the money. What's going to happen is that the creditor is going to come after the partnership. And the creditor is going to look at all the general partner. It's going to say, look, I can't find this guy. All of you are responsible for paying back whatever money that went missing.
Yeah, so that doesn't work. So it sounds like we've identified what doesn't work, which is creating a company that owns the commercial building and then fractionalizing ownership of that company. Tell me again, what's the structure that you came up with that does work?
The structure that we came out that does work is actually a derivative of sort. And so what as a real estate token holder, effectively the only rights you have is the right to buy out all the real estate token holders to redeem the title deed of the property.
The only right you have as the owner of the derivative token is to buy the rights of other token holders?
To redeem the title deed of the property.
Redeem the title of the property?
Yes, redeem the title deed of property. So that, but having said that, it also means that being a real estate token holder doesn't make you a fractional owner of the underlying property. Neither does it make you a fractional owner of the SPV or the special purpose vehicle set up to own the property. Now, this very unique difference in terms of structure not only protects the rights of the token holder. It also enables us in jurisdiction in Singapore to obtain a legal opinion to say that, look, your tokens in this case, our token in this case, are not a security token. So it doesn't fall under the definition of a security token. It's not going to be regulated. And that is actually one of the more important part about building these real estate tokens.
And so
in a DeFi.
Sorry to interrupt you. Just to make sure I'm clear, tell me if this is right, and then keep going. But the owner of the commercial real estate building would be an LLC, and then the partner in the LLC is. I'm a little lost there. So how does it? What is the derivative? How does the derivative connect to the owner of the property?
The derivatives don't connect to the owner of the property, because when you connect to the owner of the property, you're always subjected to counterparty risk.
Got it.
Whereby the owner can always run away or can always dispute. It has to connect to the title deed of the property.
Are you saying title of the property?
Yeah, the title of the property, because that's when you have a truly bearer token that give you indisputable rights to the underlying title deed.
So someone could own the title, and that would be a separate person that owns the building?
Yes, so someone will own the title, but as a real estate token holder, you own the right to claim that title anytime you wish to. So if you look at it from another point of view, the person who is owning the title in the meantime is just holding the title in trust, sort of, for the real estate token holders.
Got it. So there's a company that owns the building, and then there's a title that's separate. Those two things are somehow connected. I'm not quite sure, but there's maybe tell me what's the purpose of a title here if it's not to establish the ownership in the building?
The title is to establish the ownership of the building.
Okay.
But the right to claim the title deed ensures that at any point in time you can be the true owner of the building.
Got it.
But as the token is traded in the crypto space, you don't necessarily have to be the true owner of the building. Because let's look at let's just be practical here. Being a true owner of the building, what rights does it give you? It gives you the right to sell the building. It gives you the right to manage the building. It gives you the right to lease out the building. And that's basically it, right? And to be honest, most fractional token holders will not want to be in the business of managing the building.
Yeah.
Right. For example, if you have one or two building, maybe you might take special interest in it. If 1,000 building, you don't want to deal with the tenants. You don't want to deal with the facilities.
No.
You don't want to deal with choke toilets or something like that, or electricity box blowing up kind of stuff, right? These are things that you don't want to manage. The only thing you want to do is kind of like have be able to participate indirectly in the value of the building. Yeah.
Okay, so let me make sure I have this correct. So there's a title, which is a piece of paper, and that title states who owns the building. And the title may say like Joel LLC owns 100% of this building at this address. Now the title is just a piece of paper. It's just like a contract. So the contract in and of itself is not worth, it's nothing. It's just a paper. But the content of the contract is valid and important. And is what the government recognizes. So they're going to say, okay, who owns this building? Let's see the title. Let's read the title, and then let's refer to the title for the ownership. Now, when you say that a crypto a token holder has a right to the title, what I'm understanding is that they somehow have their ownership in. That's why I'm a little lost. Yeah.
It basically means that you have the right to change the name on the title anytime you want.
So you can change the ownership of the
title deed.
Yeah,
anytime you want. So it means that while you're trading the fractional tokens, you don't really have to care about that. But if you really want to take control of the title, maybe maybe if let's say the price of the tokens trading on the crypto space, for some reason or another, it has a black swan event, it becomes like a terror, it falls below the real world price of the property building. You might want to buy out all the other token holders, and then at that point in time you want to redeem the title so that you get the right to sell the building in the real world and collect a profit.
Got it.
In that instance, then it makes sense to execute the redemption function, change the name into your name so that you could then effectively sell the building in the real world and collect the proceeds from there. That's when you execute your right as the owner of the building. Otherwise, in between, you don't really want to be the one managing the building.
Right, I see. So would the title list the DAO as the owner of the building, and then is that the okay? So somebody
The title will list a separate independent LLC company as the owner of the building.
Now, what validates what gives the people, the token holders, the right to change the title?
The law.
Okay. I mean,
So
because
the
I would think the owner of whoever the title states is the owner of the building would have the ability to change who's on the title. No. Okay.
No, being able, the owner of the building will have the rights as owner of the building at a point in time when his name is on the title, right? And yes, if he sells the building, provided he sells the building, he might be able to change the name on the title deed also, right? But owner of a building is not always the superior title holder. And a legal instrument, we created a legal instrument to allow the token holders to claim superiority of title over the owner of the building.
Wow, that's super interesting. I find this so fascinating because it's not how I would have thought that the owner of the building is the one listed on the title, and that basically validates his legal right to own the building. And he has the right to sell the building because he's listed as the owner. And when he sells the building, the title would change and it would be the new owner on the title. And the title is basically like the contract that says who owns the building. But what you're saying,
that's the that's for the that's where most retail participants will probably understand it. But if you have some experience in the institutional private equity space, you realize that there are ways to create superior title claim over and above the owner of the building, so that you could at any point in time, contingent on you meeting some requirements, be able to claim over that title anytime you want from the owner and execute your rights as the new owner of the building.
Wow. Okay. So would it?
So effectively,
yeah.
as a real estate token holder, you're a contingent owner of the building, but you're not the current owner of the building, and therefore, because of that, it kills two birds with one stone. Effectively, it also makes the real estate token. It helps to circumvent all the, or rather overcome all the challenges that kind of makes it very difficult for a current real estate tokenization project to expand because of each, that I mentioned earlier, each individual state or country have their own unique land laws that apply to the owner, the current owner of the property. So being as a real estate token holder, if you're not the owner of the property, you're not the owner of the SP, effectively you don't have to comply with any of those, right? And then to bring it one step further, because now you're also not the owner, fractional owner of the building, in some ways because of that, you don't even have to comply with regulators. It's an unregulated token. And the power of unregulated token cannot be underestimated. And let me explain to you the difference between regulated and unregulated token from a commercial perspective. Now, if you look at the DeFi space, the crypto space today, most projects are not regulated. Mm-hmm. And to tap into those projects, to be able to increase the use cases for the real estate token, you need to be kind of composable or rather compliant with those projects. The moment you say that you are a regulated token, those projects will be like, hold on a minute, I'm not going to get into trouble doing regulated securities, right? But if you're saying, look, I'm unregulated, right? I'm not a security token. You open doors that were never once available to any tokenization projects. And those doors I'm looking at are like doors that allow you to mint stablecoins, doors that allow you to do collaterals, doors that allow you to participate in AMM liquidity pools to get 24/7 liquidity, doors that allow you to use the token to mint futures option, doors that allow you to create your own indexes. Imagine in the future, everybody can be a fund manager.
Mm-hmm.
Those kind of opportunities unlock only when you are not a security token. The moment you're a security token, all the doors are closed.
Yeah. And that's where the DAO makes more sense than a token that's managed by a centralized organization. Got it. All right. So the building's owned by somebody who is stated on the title, and this title is a special kind of title, and it's like a super title that has the only way that the owner of the building can sell is if they have the approval of CitaDAO on there or something.
No,
Okay.
no, they can't even sell it even in the real world. The only way they can sell it is by buying out all the real estate token, redeeming the title.
Got it.
And then sell it.
And that because the title will say every token holder has to agree before you sell the building. So if one, okay.
No, the title will say that whoever who owns this NFT that is unique to this title will be able to will be the true owner of the title.
Oh, okay. So if they own the NFT, meaning that if the NFT is a bunch of tokens, then the only way one person can own it is to buy out all the tokens.
Yes.
I appreciate your patience and sticking with me through this.
I mean, the legal part of it is it took 7 years before we got to something that two law firms are willing to issue legal opinion on.
Wow. I mean, so it's where all the innovation is. Like I thank you so much for going through it and explaining it, because that's where all the breakthrough potential is. You know, it's like, unless you have an intelligent way of having like an owner of the building that has a title, that has the right on the title, says that the NFT, the owner of the building has to be the owner of the NFT as well. And all the mechanics of that are that's the substance of, as I see it, what you built.
Yes, precisely. So it's a new way of building it, and precisely because of this, we are able to. I think we are the only one out there that kind of leverage the full potential of the blockchain, the full potential of the DeFi ecosystem to increase the value of the real estate. So let me give you a case in point of what you can do with the real estate. In fact, we have our very first real estate token today, and you might even want to go and try buy like maybe $10 of it and go through the flow, right, to experiment with it yourself. But what you could potentially do, you could buy, if you own the real estate token, you could pair up with a USDC, put in a liquidity pool, and earn incentive reward by way of the platform governance token. At currently the rate is about 29%. So even then, it's already superior to your real estate return already.
What is 29%?
Now, let me just take a look at what the current rate is. I believe it's around 29% for the real estate token. Yeah, 29%. So it's 29%. So imagine, right? Okay, so today, let's say you go out there, you buy a piece of property, right, and you rent it out, and you get a very decent, a very good tenant who's giving you a rental yield of 5%. That's very good, right? Mm-hmm. You're happy, right? But that's it, right? There's nothing more you could do with that. Now imagine if you had tokenized it instead, and tokenized it on the CitaDAO platform. Now your real estate gives you the 5% rental income, which is used to buy and burn the real estate token, so effectively increasing the value of the real estate token over time. You take this real estate token, you pair it up with a USDC, you put inside a liquidity pool, and you earn the trading fees from the liquidity pool, and you earn the incentive reward. Of right now it's 29% APY, which is basically reward getting paid by the CitaDAO platform governance token, the DAO token. Right now you get your 5% rental yield, you got a 29% incentive token, and you got your trading fees. Effectively, you got a return of over 30% already.
Wow.
APY.
Sounds too good to be true, but I understand
And then you take your LP token, because you LP, right? So you take LP token and you go and collateralize it at a collateralization ratio of maybe 50%.
You take your LP token,
now,
collateralize it
at 50% collateralization ratio. So instantly getting 50% of the whatever money you put in out.
Okay.
Now, remember I say you got 30% return, right? I think it's 29 plus 5, so you got like 34, then plus the trading fees, maybe 1-2%, so you got 36%. Now, you collateralize the LP token at collateralization ratio of 50%. Effectively, you take out 50% of whatever money you put in. Now, the return on whatever money that's still locked up in there goes up. Let's just take a simple 35%. It goes up by 2 times. So now you're making 70% APY.
I'm mostly with you here on conceptually understanding this. Where is the 70%? When you say collateralize it, you lose me a little bit. But where does the 70% come from? Like who's paying 71%?
So let's look at the numbers, right?
Mm-hmm.
You have $10.
Mm-hmm.
You bought $10 of real estate token, right? Now, this $10 of real estate token is giving you a yield of 5%, so you get 5 cents. Let's not $100. Let's use $100. Mm-hmm. Okay, so $100 worth of real estate token is giving you 5% rental yield, so you get $5 in capital appreciation every year, mm-hmm. right? Now, assuming the price of the real estate doesn't change in real life, okay, so now you got 5% rental yield. You take this $100 worth of real estate token, okay, you pay out with another $100 in USDC, you put inside a liquidity pool. Now, and the liquidity pool is Uniswap V3. You put into a Uniswap V3 liquidity pool, okay, and you set maybe a trading fee of 0.3%.
Okay.
Right. So now you're earning the trading fee from the liquidity pool. You're earning the 5% rental, the $5 that you're getting, okay. But above and beyond that, how we incentivize liquidity as a CitaDAO project is to leverage our DAO governance token and reward you at a rate of 29%. Right now it's 29%. I mean, as more and more people come to liquidity, it might drop.
I see. Okay. All right. That's the piece I was missing. So the 29% comes from a choice that you made to give out 29% based on your desire to grow. That makes sense.
No, we will, the DAO will incentivize the liquidity. So I'm going to give you a link here. Okay, just click on this, you'll see. So effectively, you're looking at basically the DAO will put X amount of governance token by way of DAO governance vote into this liquidity pool to incentivize liquidity for this property, and the LPs, those who participate in the liquidity pool, will share pro rata in the incentive token deposited into this pool.
Gotcha. So let's just show what we're talking about. And you can see my screen. I just figured I'd try it. I don't usually share a screen, but gotcha. So
so effectively, you're looking at a 29% liquidity pool there for 100K kind of pool, right?
And so I'm looking at 20. Okay. So 40,338 USDC, 55,000 of something else, and pool balance.
That's the real estate token. Okay,
this is the real estate token. Gotcha. Gotcha. My deposit. All right. And then people, and this 29% is set by the DAO.
No, the DAO basically deposit 100,000 DAO governance token per week. You can see over there.
I see.
So that effectively forms the and the participants liquidity pool kind of share on a pro rata basis on the distribution of the reward token, right? The next
Gotcha.
token. So if there are more people in the liquidity pool, the percentage might decrease. If there's less, it will increase, right? So now you're getting that kicker on top of your renter. You're getting the kicker and you get the trading return.
Interesting, man. So take a step back for a second. How is this going? Like, how many buildings have you helped sell, or how many people are holding token or money raised, or what are the measures of traction so far?
It's on the blockchain. So we have 2 projects so far. One was successful, the other was unsuccessful. The unsuccessful one, 8 million was raised, but the target was 11 million. So it didn't clear. So the token wasn't created at all. This one, on the other hand, is a $630,000 building, or rather space. And sufficient interest was raised. So effectively, it went on chain. For the first one, we had about 200 plus 300 participants. People were coming in for as much as a couple of million bucks, and as low as $2, literally $2. Wow. And the beauty about it is that's the beauty about blockchain, right? You can't hide. It's always there on the blockchain. So I'm going to share with you the token contract for that. You can see for yourself the participants. Yeah. So effectively, let me just get you the contract address. Here you go, and here. So this is the first one. This was the one that was not successful, and you can see that there's a crazy amount of transaction that took place here. For altogether 477 transaction. Give me a while. Let me find it.
Yeah, sure.
And this is it. Yeah. So this is the blockchain, right? So yeah, and so that's the beauty about our project. We leverage the blockchain fully.
Yeah.
No other tokenization project does this, right? We do the public blockchain. This is the unsuccessful one, as you can see over here. You can see that people deposited cash. It went as high as a couple of $1 million for some individuals. Some of the whales came in at a couple of $1 million. That was when the crypto market is still doing well. And then it went as low as a couple of like $50, $2. Yeah, you have to go to the first one. So you have to click last. And then, so you click last. Yeah. Because right now you're observing all the ones that are coming up. Yeah.
Oh, I see. Interesting.
Yeah. So, and then you just can scroll through, and you see you just scroll through the arrow, yeah, and you will see all the participants coming in.
Wow.
For different amount.
And so these are all people who are.
And you will see all the different events.
So enough people bought into this where.
Yeah, I have one guy coming in for $2.
That's right? Amazing. And so now currently there is a building somewhere in the world that has an owner or a manager, and separately on the title, this sounds like the innovation is you wrote a unique kind of title, and it's approved by lawyers, and it references ownership of the NFT, which is I don't know where the NFT would be, but somewhere here there's an NFT, and in that it says in order for someone to sell this building, you need to own the NFT. In order for the owner to own the NFT, they have to buy out all the token holders.
Yes. But it's not the title deed that is special. The title deed is state issued. It's the same state template issued everywhere. We create a legal instrument that allows you to claim the title deed. Got
it. Okay, that makes sense. Fascinating. And so you add the NFT portion of it, and part of the way that you structure this contract is that the owner of the building can at any point buy out all the token holders. I mean, you don't need their everyone's. You don't.
Anybody can anybody can at any point in time make an offer to buy out all the token holders. Now the buyout process is unique in the sense that it's kind of a bullshit kind of process whereby if you make an offer to buy out everybody at a price, you must be prepared for everybody to buy out your token at the same price. So
Okay.
yeah, so it makes you it kind of forces you to make a fair offer in order to trigger the buyout contract so that you can buy out all the other token holders. You will need to own at least 30% of the available float. So for let's say a $1 million building, you need to own at least $300,000 worth of tokens before you can trigger that, and then you make a buyout offer for the remaining 700,000 tokens, right? So for the remaining 700,000 tokens, let's say you make a buyout offer. Let's say the trading price today is $1, okay? And you make an offer price of $2 per token. Effectively, you have to deposit 700,000 times 2, so that's about 1.4 million in USDC into the contract to successfully buy out everybody. But let's say you decide that, hey, you know what? Let me try and lowball everybody. I'm going to offer 50 cents to the dollar, right? So if I'm going to offer 50 cents to the dollar now, the 700,000 tokens, I only have to fork out 350,000 to buy out everybody. That sounds like a very good deal. So let me put in the 50 cents offer. Here's the catch. When you put in the 50 cents offer, your 300,000 worth of real estate token is immediately available for sale for 50 cents or so for the same price.
Oh, okay.
Which means that everybody might end up buying you out at $150,000.
Wow.
So it forces you to make a good offer price before you even trigger the buyout.
Yeah, I mean, you're pretty
It's designed as a
interesting.
black swan mechanism.
So if you do that, if you make a lowball offer, you could just get bought out by everyone else, and they resell it on the market 2 minutes later for more than you lowball. So it makes it really, really hard to offer anything below what the market price is.
Unless you know that the price in the real world is trading at a premium to what you're offering.
Right. Unless you know the price.
So it prevents a UST kind of crash scenario where the token price can crash to zero, which is another very real problem of all of many tokenization projects that we were analyzing in the past. Because most of the time, we look at the project founders and we say, look, I want to redeem the title deed with my real estate token, with your real estate token. How can I do that? And the answer to that is no, it can't be done, right? And that creates a very dangerous scenario where you might end up with a UST scenario where, let's say everybody has short the real estate token and the real estate token crash. You could perpetually go down to zero because there's no way you could actually use it to redeem the actual property value in real life. In our case, we actually designed that system in place so that now, let's say it departs significantly from the actual property value. A mechanism is in place to incentivize what we call liquidators to come in, buy out everybody liquidate everybody by buying everybody out, and then redeeming title deed in the real world. Now the real world price may not have changed. They sell it for profit there.
Got it. So if the price of the token crashes, now there's a market opportunity for someone to just buy all these cheap tokens and then sell it in the real world, and that prevents it from going to zero, but it doesn't prevent it from going down in the first place.
Yes, but it ensures that it typically what we do have also, what we have built also is a money valuation process whereby the price of the property in the real world is constantly updated on chain by valuers in the real world. So effectively, people will always know what the real value of the property in the real world is, and that kind of help to create a market run on the real estate token.
How is that done?
So yeah, real estate.
What say that piece again?
So basically, valuers in the real world will provide a money valuation feed via Chainlink. So we integrated a Chainlink on chain for that will give you the actual value of the property in the real world. So if let's say the trading price of the token differs significantly from the actual value, now you know what the property is worth in the real world. And if you go and validate and you think that, hey, this valuation that come in is something that I could liquidate in the real world for, and the price of the property token is trading below that price, now you trigger the arbitrage opportunity by buying out everybody.
And then sell the building.
Yes.
That's a big move. I mean, people would have, like, I don't know, I wouldn't be comfortable buying everyone out and selling the building. There's people who would, though, right? They would understand how to sell commercial real estate and be comfortable buying everyone out.
Your private equity funds will love this.
Yeah. Okay. And
they'll probably be squawking.
How did you build all this? Like, what tools did you use? How many people? I mean, did you learn to code? Did you have a partner that helped build this? What?
We have a team of very experienced engineers.
When you first started, so it's you have this idea. What happened next? I mean, are you?
As I shared, this is a DAO. So being a DAO means that it's never one man's effort.
Okay.
We have a bunch of core contributors like myself, each specializing in their own area of expertise. My area of expertise is in real estate and helping put the legal structure in place. Their area of expertise is in coding, getting set up. So we work together to make this happen.
Got it.
And our contract is also audited by ABDK, which never appeared on the whitelist before. So definitely something to that we respect, someone that we respect a lot.
You said that this law firm gave a review on a
the smart contracts audited.
Smart contracts audited, got it. By a law firm that is well respected.
No, by a smart contract auditor.
Smart contract auditor. Okay. And it sounds like you met a couple of developers and then partnered up with them to create the DAO early on.
Our developers are very experienced developers. They are OGs in a way.
Okay.
Developers, good developers are very hard to find. And our developers, we are fortunate to know them for a very long time. And they have launched very successful projects before. And right now they have led the development team of some of the more successful token projects out there, and they have kindly offered to help us build this together. Yeah. So because obviously for a successful real estate tokenization project to come together, it's not just about the legal structure. The legal innovation is one part. You need the tech guys as well. You need the you need the capital. It's very heavy capital. So you need funds ready to support you with the real estate, right? Landlords willing to believe in you, willing to give you the property to tokenize and stuff, right? It takes a lot to put all this together. And so, to be honest, our project wasn't put together overnight. We literally started building this as far back as 7 years ago. And the opportunity to get it off the ground really came during DeFi summer, when the concept of yield, the concept of AMM liquidity pool, and so on and so forth became well understood, became well adopted. Yeah. And that's how we actually built from there. So we are very excited. We believe that the next trend on chain, given the recent collapse, right? We believe that everybody has become a lot wiser, a lot smarter, less degen. We believe that the next trend on chain will be tokens that are actually backed by real world assets.
I agree.
And we believe
I totally agree.
And we believe that these real world asset backed tokens will open the gateway for even more new capital in the TradFi world to move into the DeFi world. And let me give you a very simple personal experience why I believe this to be the case. Back in the days when I was first introduced to Ethereum at $10, I didn't buy Ethereum at $10 because I was a typical TradFi guy who strongly believed in my valuation model. And for a token that doesn't have the balance sheet, cash flow statement, income statement, I could not I could not figure out like what the real value of the token is, right? So because of that, I'm afraid to put in the money. And there are many people like me today that I mean, like the old me today, that are still in the world today. We are meeting these people, and they're telling me that, look, I'm not willing to put, I'm not willing to move like $1, $10, $50, million, right, into the DeFi world, to buy Bitcoin, Ethereum, because you look at how crazy the is. I can't value it. But real estate token, that's something I'm familiar with. That's something I can see, touch. That's something that has a balance sheet, cash flow statement, income statement. This is something that I'm willing to put my money on.
Yeah.
And imagine us using real estate to bring all these millions, all these billions of capital from the TradFi world into the DeFi world.
Yeah. Oh, I'm totally with you. I mean, it seems to me like the key thing here is what we drilled into deep, which is like, how does the government recognize the on-chain entity? And like, that's the key thing, right? It's like, I mean, what you enunciated and we went back and forth to explain is like the government, and through these law firms that have audited, like the government has to say, okay, Jeremy, you can't sell that building because you don't own an NFT. If Jeremy can go and sell the building, he's like, fuck that NFT, then the whole thing falls apart. But if Jeremy has to actually go and buy all the tokens on chain in order to sell it, well, then magic happens.
Yeah, and the beauty about it is that you're protected by the same precedent law case that protect all the other landlords, that protect all the financial institutions, the private equity platform out there. You're protected by the same legal framework. That means that if, let's say, somebody fraudulently try to undermine this legal structure and try to sell the building, collect the money and run away, the person who paid the money to this scammer will be the one who loses out, not you as the token holder, because then he will have to go and recover his money without laying claim on the property.
Right. No, that makes perfect sense.
Yeah, it has to be 100% barrel. It cannot be a case where you have to trust a counterparty.
No.
You cannot be subjected to that kind of counterparty.
Absolutely. And I think that, I mean, I know that your co-founder, whoever helped build it in the early days, like the tech is definitely an important thing, but here the structure of the legal is super, super, super important. So
yes.
Yeah, to your point, to your credit, you had a background in doing this, and you guys have been working on it for a long time. Thanks for hopping on a little over too, Joel. I know we went long, but I felt like we were in a good flow, and it was really, really interesting. So you guys have raised some money. You've been around for 7 years, kind of in thought, and then at least the last couple of years in practice. There's 2 properties. One has been successful. Are you raising more money? Are you hiring more people? Are you looking for? Can investors in crypto like participate in more deals in the coming future? Like what's coming down the pipeline?
We have a bunch of properties coming on the pipeline. So the beauty about our platform is that it's permissionless. I mean, for now it's still not yet fully permissionless, but in the future it will be. So for right now at this point in time, we do have the real estate token on chain. So we do encourage the crypto community to participate, maybe yourself included, to go and go to Uniswap, get a couple of the real estate token, play around with it, get to know for real that whatever returns you get can actually be exchanged for cash. That these are real returns, it's not fake returns like the Ponzinomics project that we've seen that caused the recent collapse, right? And then and get to and then participate in the DAO, earn the Knights token, and be patient. Over the course of the next 1 to 2 years, we have a master plan in place. We have secured deep pocket investors, or other deep pocket landlords who are willing to support us to increase the TVL of the project with the real estate that they own. Now, naturally, the DAO. So probably let's go into some of the part which never cover, the value of the NIKE token, where the value of NIKE token is. Now, the value of NIKE token is such that every time a property is successfully tokenized, 2% of the NIKE token minted will be sent, 2% of the USD token will be sent directly to the DAO treasury. So the DAO, as the token holder, you will basically not only own 2% of all the property tokenized today, but 2% of all the property you tokenize perpetually in the future. Now, that's a very huge market. You're looking at 280 trillion market. So 2% of that, you can just go and count. It's probably more than worth, the market cap is worth more than Bitcoin itself today, right? That's one. The second one is obviously all the trading fees that were generated. And the third one, which we believe will be the most valuable, is the governance right to the DAO, the ability to set rules and regulations to shape the demand supply curve of the DAO token. So imagine in the future when landlords realize that, hey, you know what, if I'm going to list my property on the CitaDAO platform, I'm going to get maybe $1.1 million versus getting $1 million in the real world. How I'm going to CitaDAO platform, I'm going to list, right? And everybody is rushing to list on the platform, right? Imagine being on the governance side of things. You say that, okay, everybody who wants to list 1 million property, you have to hold at least 10% of your property value in the NIKE token.
Okay.
Instantly creating demand for the NIKE token.
Yeah, that makes sense. Can you see the property address? Like, is that listed publicly? That's sold on chain? Yeah. That's awesome.
Yeah. And all the and the property right now is still under development, but it should be up definitely within the next quarter. We are going to have a live update in terms of the bank account of the property, in terms of the transaction of the property, all the legal documents stuff. So basically, you're going to see it so transparent. It's going to put the REITs to shame. We are moving towards the flow where we believe everything should be. That's the principle of DeFi, right? Transparency, right? So we're going to put it in such a way that the bank accounts are fed online, so you get to see the flow of funds at all point in time, the rental income coming in, the rental income being used to buy and burn the real estate token, and so on and so forth, right? Nothing to hide there. We believe that level of transparency will build further credibility, convince more people to move into this space, park their money, see this as a safe haven, and potentially in the future leverage real estate as one of the key gateway to bring TradFi capital into the DeFi space and grow the DeFi space in a sustainable manner that will ensure a longer, better run for the next run up than what we have seen over the last 1 year.
I love it, man. I think it makes a lot of sense. I think inevitably it's going to happen where the traditional real estate market moves on chain, and it sounds like you guys have made a ton of progress and have thought a lot about this. So wish you guys the best, man. Hope you keep crushing, and I'll keep an eye out for new property listings to participate in.
Thank you, Mike. Go to Uniswap. You saw the token. You could buy any amount, $10, $5, $2. Please play with it, learn how to use it, and then the next time round, wait for the next IO coming up. The next IO coming up, we are potentially looking to set up clubhouses, whereby now your real estate token could be used to earn the right, earn another token that gives you the right to use the space. So
wait, you lost me a little bit.
Next time you hop over,
you said set up an IO for a clubhouse. What is break me down?
IO is our process of introducing real estate on chain. That's what it means. And and we believe that beyond just renting out the properties, the real estate token holders should ultimately be able to enjoy the property in a indirect way. So imagine being able to stake your real estate token to earn, let's say, a co-working DAO token, which can then be used to redeem for hours at a co-working space.
Wow.
Or a co-living DAO token, which you can then use to redeem for hours at a co-living space. Now, that's something we are very excited. We are very close to achieving. So maybe by the next time you come by Singapore,
Yeah.
or we're going to have properties in Singapore, UK, Australia, Canada. The next time you hop over to the country and you own the token, I might be able to hit you up there
Yeah.
in our CitaDAO space, and we can probably have around the coin physical, maybe even an NFT
Yeah.
event in a CitaDAO
That sounds
space.
great, man. Let's do it. All right, brother. I'll talk to you soon.
Take
Bye.
care. Bye.
Sweet.